our last class, in not your last class, but in my last class, which is 2-hour class, I was doing this, but the whole time I forgot to start, press recording. So the whole 2 hours, just not wasted, but not recorded, which was so disappointing at the end of the class. So let me share my. Hey, good evening, Candice. Yeah, I got your email. So oh, you're welcome to join by Collaborate. Okay. Okay. Hi, Ebony. So we have 4 people by Collaborate, and cost of capital. Now, the Excel file, right? The Excel file we used, where is it? In our last class, that's gonna continue to be the Excel file for the rest of the semester, because corporate finance topics. This is not only for capital budgeting, but also this is basically, the example in the cost of capital. This is like a very extensive, very extensive example. So that will be our file for. Okay, and where is my? All right. So this one, I hope everyone can see this. I can even draw on this. This is good. We already understand a lot about cost of capital, because cost of capital is the discount rate, right? But when we say cost of capital, it means weighted average cost of capital, right? Weighted average. It means weighted average cost of capital. First of all, the K for cost of capital is the average rate paid for the use of the firm's capital funds. Average rate. That means weighted average. Right? Weighted average. And the capital is the money acquired for use over long term. So when we say capital, it's always long term, right? Don't forget. Short-term financing, right? It's not called capital, right? Short-term financing is just something that happens. And the cost of capital provides a benchmark against which to evaluate return on investment. Yeah, our return on investment must be greater than cost of capital, right? And the project should not be undertaken unless they return, in other words, the project's return, something greater than the cost of the funds invested in there. So cost of capital breaks down into these 3, these are the cost of debt, cost of preferred stock, and cost of equity. Okay, three it's called capital components. Capital components. Okay. So when we say cost of capital, it's the weighted average of these three capital components. Now, we all know projects' internal rate of return must be greater than cost of capital. A project's net present value must be greater than 0, another positive, when calculated at cost of capital. Of course, if you find the present value using this as the discount rate, it should be equal to net present value should be equal to 0. Yes.
So what's KP?
Cost of preferred stock. Okay. Preferred stock, right? So now we are distinguishing the equity into we are classifying equity into common stock and preferred stock, right? So the equity, this means common stock, right? That means common stock. Preferred stock is pretty much treated like a debt. It is not debt technically, but capital components. A firm's capital components are, of course, debt and common equity and preferred stock. The difference between the common stock and preferred stock is that the common stock carries voting right. Common stock is the true equity. Preferred stock doesn't carry any voting right, right? Sometimes they allow only certain percentage of the preferred stock to have voting right, but in general, preferred stock, it's treated like a debt. Now, so capital structure, we already know what capital structure means. It's the composition of how much of the total assets came from equity, how much of it came from debt. But since we have additional capital component, preferred stock, the capital structure will consist of these three components, right? So in this example, the total capital, once again, total capital is not the same thing as total stock. The total capital is not the same thing as, in other words, you should understand, total capital is not the same thing as total assets, right? Everyone understands that. Why? Total capital is only long-term capital, right? Long-term capital. Total assets include also, short-term assets. So short-term assets or current assets. So obviously they cannot be the same. Total capital is greater than, total assets is supposed to be greater than always total capital. Now, and take a look at our example. So this company has $30 million in debt, 10 million in preferred stock, 60 million in equity, which means common stock, right? So if you add them up, that's 100 million, right? And the capital structure is 30% debt, 10% preferred stock, 60% common equity, right? Common stock, right? So that's basically what it is. And they will serve as the weight. The capital structure will serve as the weight for the weighted average cost of capital, right? And there is an optimal capital structure. What is optimal capital structure? Optimal capital structure is the capital structure that maximizes earnings per share, and therefore that maximizes return on equity. Okay? That means, to put it simply, right? If we do not distinguish between common stock and preferred stock, and let's just call it just stock or equity, and then the capital components will be only debt and equity, right? And then empirically, the optimal capital structure is found somewhere between, and I believe I mentioned this, before. The capital structure, optimal capital structure is somewhere between 70%. That means, debt will be 30%, or, 60 to 70%, 32. I cannot write anymore there. Okay. So what do I do? How do I have to erase? Empirically, this is right. Empirically, somewhere between there, right? The optimal capital structure is found. So most companies would have their target capital structure, right, to be, their optimal, right? Optimal cap. They want their optimal. They target at their optimal capital structure. So, so they will raise fund in proportion to capital structure. In cost of capital calculation, assume fund is raised in a constant proportion of debt, preferred, and common equity, usually either the current or target structure. They will, if their current capital structure is not the optimal one, then they will raise capital to match the target capital structure, right? Although it's somewhat unrealistic. I mean, reaching the target capital structure, it's unrealistic because in reality you may not exactly nail it, right? Just like the Fed funds rate. Why? Fed funds rate is not exactly 0.25%. They always give some range, right? Fed funds rate is somewhere between 0 and 0.25. And now we raised the interest rate in the last meeting. So target range is between 0.25 and 0.5, right? And then the next time they raise it again, it's going to be in, around somewhere between 0.5 and 0.75. So in other words, it's not a point estimate, it's rather a range. Because in reality, the Fed funds market rate cannot exactly hit it on the nail, because it's a transaction constantly in the Fed funds market, right? Every day the transaction will always, the rate is just, it's like price. Rate is the result of the transactions, buy and sell, right? Or borrow and lend, right? Borrow, the rate is like, the Fed funds rate is the result of, borrowing and lending in the Fed funds market. So you cannot exactly hit
hit it on the, hit the nail on the head. You will have to, as long as the rate is within the range, and the Federal Reserve is trying to maintain the Fed fund actual market rate, actual Fed funds market rate, close to their target range, right? So just like that, target capital structure is a kind of range, right? But you cannot you may not, it's unrealistic that you will have exactly 65% of the, right? Because it's constantly, why? The valuation of debt and equity are constantly changing, right? Valuation of debt and ROI, cost of K components, and weighted average cost of capital, right? So return on investment adjusted for taxes and administrative expenses are the firm's cost of capital. The risk levels of capital components differ. They differ. Equity is, of course, the riskiest asset, right? So it requires highest return, right? So the cost of capital, cost of equity is the highest. Debt is the safest asset, the safest, capital component. So it requires the lowest return. It's the lowest, cost of debt is the lowest. Preferred stock is in between. So maybe I should just, I guess this is okay. So the hierarchy, there's a hierarchy, right? There's a hierarchy. Cost of equity is the greatest, cost of preferred stock, in the middle, cost of debt, the lowest, right? So a firm's cost of capital is the weighted average of three capital components, where the weight reflects the dollar amounts of each component in use. In other words, this is the weight, right? Right? If they use current capital structure, right? And this is the weight of debt. That's true. There should be a better way of doing this instead of. Okay. This is called weight of debt, weight of preferred stock, weight of equity. Weight being those. And we all know what weighted average, weighted average is, right? So in this example, debt is 60K, preferred stock 50K, common stock 90K, and the cost of debt is 9%, preferred stock 11%, common stock 14%. Then the weight will be 6 over 20, right? 5 over 20, 9 over 20, right? So the weight will be 30%, 25, 45%, multiply, right? And it's going to be 2.7, 2.75. So we already understand what is weighted average, right? Weighted average is basically,
sum of each weight where I runs from 1 to 3. I mean, if we have 3 capital components, right? I think it's better to, rather than this, where, I hate. Where I refers to debt, preferred stock, and equity, right? So basically that's what happened here, right? 6 over 20, right? 30%, right? You divided this by this. Why don't they have undo button, right? So basically what happened here is exactly this. It's not a difficult thing. Then next question is, what do we use? Do we use book value of these assets or the market value of these assets, right? And you understand the difference between the book value and the market value, right? Book value is always past, right? It's based on the past data. Because the March has just ended, right? March has just ended. So the first quarter just ended. First quarter has just ended. The first quarter data will only come out in April, right? But then by April, by the end of April, it's called, so first month of, always the first month of the quarter is called earnings season, because earnings data, earnings per share, right? Earnings data, earnings report comes out. But that earnings report is from the previous quarter, right? So in April, we'll get the first quarter earnings report. So we will have new book value, right? But then this new book value is still book value of the first quarter. So by May, this will be already a distant past. By June, this will be 2 months ago. But that's the current book value, right? And the market participants cannot rely on the book value to evaluate the value of the asset, right? Price of the asset, based on the data that's 2 months already 2 months old. So they make their own they make their own estimations, right? And usually, if they estimate, I mean, at least, if they can make an estimation, at least that's fine. At least, estimation is something mathematical, right? And if all the market participants can do that, then that's fine. But then, at least they are doing, some mathematical thinking. But most of the times, unless you are an institutional investor, otherwise, a lot of individual investors are just retirees, either retirees or just some plain Joe or Jane who's just playing stocks, right? Who likes to play stocks. And then the problem is they depend on they rely on a lot of noise, right? Noise, nothing but rumors. So that's why the market value, market price can significantly deviate away from the book value,
right? And of course, when we say market value is already reflected in the everyday, the price, the trading, right? The price is determined by the trading every day, market prices. And this market price reflects this average Joe and average Jane's, perception about that particular stock or that particular company, right? Now, of course, that should be scary if if the market price is determined by average Joe. But even the institutional investors they don't care what is, unless they have the capacity to value it correctly. They know, at least institutional investors know what is, discounted cash flow model and et cetera, et cetera. What is, capital. But it doesn't matter. They also want to make quick bucks because all fund managers, their performance is measured by, not by long-term return, but by short-term. The clients are very impatient, right? Don't you think so? Clients are, the clients who are putting their money with this portfolio managers are average Joe and average Jane. They are impatient, and if this fund performs poorly, then they pull out their money. So the fund managers are also impatient, right? Because they have to show some result, even in the short run, right? I don't know if anybody ever heard of, Kathy Wood. Anyone heard of Kathy Wood? Yeah. Who's Kathy Wood?
She's an economist.
No, Kathy Wood is not an economist. She's not an economist, but she's a fund manager. Just do some research. Google up Kathy Wood, ARK fund. But she was a hot name, last year, because her funds, ARK K and ARK F. Let's do some. Yeah, name comes up. Of course, she looks like someone who is really, badass, right? As far as the money management is concerned, she looks like someone who can. But then, her fund is not really doing well these days. Her fund, actually, I have some money invested in our ARK F. Let me go to. But she has been doing well. Her funds were doing well in the past. I mean, last year her name was like a talk of the town. Because her name was Wood, the last name is Wood, they called her nickname was even, Money Tree Sister, right? But then, let me sign in. What was my password? That's the problem. Never mind. I forgot the password, so never mind. Go to Yahoo Finance. Never mind. So try
ARC Innovative ETF. It's ETF. See, it looks like, it's been dwindling, ever since last year, December. That was December 20. But, let's see, 5 years. See?
So she got notoriety. By 2021, she got huge notoriety. I mean, for the past 5 years, and then since then, early 2022, I mean, everyone, all the funds, all the ETFs, everything went, similar way, right?
If I compare it with NASDAQ and NASDAQ, let's try this. And S&P 500. Let's do this. Look at this compared to N monthly. Let's try monthly interval. Oh, 5 years. Okay, weekly is okay. So,
look how her funds, right, performed compared to NASDAQ and S&P 500 between 2020 and, I mean, even from 2017, outperformed, right, NASDAQ and S&P 500, and especially around, 2020, 2021, right? And still it outperformed, but only early, 2022. But still, it did better than Nasdaq or S&P 500, right? But again, if you're an impatient investor, and if you put if you put your money into this fund, right? Probably, you might have gotten, disappointed and pulled out. But then you got to look at the long-term trend, right? I put my money in, not this fund. Of course, when it lost, I felt disappointed, but I didn't pull out because, long-term trend. And actually, I put my money in ARC F, which is a slightly different fund. So if you pull out your money, right, from the fund, I mean, if this happens on a massive scale, the fund manager also gets impatient, right? Because it's obviously a bad record, right, on her or his resume, right? So even the institutional investors, because of this, they are doing something irrational too, right? In the short run, they want to improve their fund's performance. They do something. But the point is, why did I come to? Yeah, book value versus market value. Once again, market value is it's basically determined by market market price is determined by demand and supply, buy and sell, right? So sometimes, irrational actions can affect, market value away from, it will move that market value far away from book value. And that's natural. That's natural. That's what I'm saying is the discrepancy between the market value and book value is just natural, right?
So which is the correct focus market? Okay.
Which is the correct focus? Do we use, as I said, book value? It's past already, right? And by June, the latest book value data that we have is as of end of March 31st, right? And when we are in June, let's say today is June 15th. I mean, how much faith do we have in book value as of end of March, right? That's why they are drifting away. Market value is drifting away. But again, I've been telling you, it's not only book value or market value versus market value. Intrinsic value, rational price or intrinsic value. So it's actually book value versus market value versus intrinsic value. Intrinsic value. What's intrinsic value? Intrinsic value is the valuation based on all those, discounted cash flow models, right? Stocks and bonds, basically, you learned pricing of stocks and bonds in Finance 100, right? And all those models are basically discounted cash flow models, right? That's intrinsic value. So intrinsic value is based on the expected future cash flow, and in case of bond, it is quite obvious. In case of bond, right, we know bond will pay coupon interest, and there's no doubt about the coupon amount, because it's the percentage, the coupon rate is 10%, is 10% of the par value of 1,000, so $100 every year, right? Which means $50 every 6 months. Okay, so in valuing bond, there is hardly any Charlie Oaks. You're cracked, right?
Yeah.
Charlie Oaks. So there is little variability, very little variability in bond pricing, but in case of stock, there's a lot of future cash flow. There's a lot of variability in forecasting future cash flow. But the idea is anyway. Intrinsic value is the rational writing. That's the rational price. And fair value, rational and fair. Okay, other names it go by. Other names that it goes by: rational price or fair value. And the interesting thing is, in an ideal universe, what's an ideal universe? in an ideal universe, everyone has a perfect foresight, right? The only reason there's there's discrepancy between the only reason that the market price is crazy in the short run, market price is really crazy in the short run, right? You saw, too much every day, even every day, there is too much fluctuation in the market price. Because in the short run, the market is irrational. In the long run, it is rational. So, because in the long run the market is rational, there's always mean reversion, right? We see mean reversion all the time. What does that mean? Even if market has a short-term upward trend, if it is over, if the market feels that this is overshooting, right? The price market trend is overshooting, then it goes down again because they sell, right? What pushes up the market price is too much demand. And when the market participants realize the market is overheated, the price is, everything is overpriced, and they sell. Then it cools down. So eventually, the movement will be, basically like a sine cosine curve, right? Sine cosine curve. Okay, let me open. Was it this? Did I use this? I believe I did. Did I? Okay. What I'm saying is the return in the long run, it will show this pattern. And this is called mean reversion, reverting to mean, right? And then if it overshoots, reverts, right? Reverts to mean, reversion to mean reversion, right? So in the long run, the market, that's the evidence of long run rationality of the market. Market is rational in the long run, but in the short run, well, there's no crazy fluctuations. That means market is irrational. But so why don't they talk about intrinsic value here? Why do they talk about only book value and market value? Because the assumption is in the long run, since market is rational in the long run, the market value will be equal to intrinsic value, right? Yeah. Again, in economics, rationality means, it's very straightforward and simple. $10 is better than $9. Isn't that right? Nobody prefers $9 over $10. More is better. That's rational, right? And then, if you're rational, then you're not swayed by the noise. In other words, somebody says, I heard it from someone who knows someone who knows someone who can get you a great deal, right? You heard this from someone, and you buy. So I buy this stock. I should buy this stock. But once again, I've been telling you that's basically Donald Trump's fault. He always says, I know somebody who knows somebody who knows somebody who can get you a great deal. But think about it. This is, what you hear this a lot from the used car salesman. Right? I'm not saying, I'm not trying to insult used car salesmen, but it's completely lacking rationality. If you're just swayed by noise. Yes, but
Do you feel like investments are rational? Do you feel like investments are rational? So investments you hear from mouth to mouth too, and
Yeah, that is not rational.
Okay.
Mouth to mouth, that's noise, right? In the long run, I mean, the investment based on the intrinsic value, right?
Mhm.
That's rational, right? Investment based on the intrinsic value, that's rational. But investment based on the noise, that's irrational, right? Uh,
So again, by looking at what is rationality, again, simply looking at this, and you see still, although there was a dip in the recent trend, but overall, there was an upward trend overall, right? So not being swayed by, not being, there are some, ups and downs here and there. I mean, that's an overall trend. You cannot get away from that trend because the entire market, NASDAQ, S&P 500, they are all going through when this fund dipped, S&P 500 and NASDAQ also dipped. When NASDAQ and S&P 500 dipped, this fund dipped too, right? So this is something you can't avoid. It's like the big ocean wave. When there's a big ocean wave, right? You have to either ride that wave or otherwise you fall under the water, right? But just because recently we had a dip, oh, I have to sell and move away. This is that irrationality, right? But looking at the long-term trend, and long-term, Nasdaq, long-term trend of the market, Nasdaq, and that's rationality. Rationality doesn't mean that it will always prevail. Sometimes it may not, right? Rationality doesn't necessarily prevail all the time. Because rationality is based on a simple and straightforward principle. $10 is better than $9. But that kind of, and also, it's also based on the very solid logic, like, gas mileage, right? I mean, think about it. If the higher the gas mileage, it means, the car is more efficient, right? Better, fuel economy. That kind of logic you can't beat. There's no way you can beat, that logic. The higher the mileage, which is, basically how many miles run divided by how many gallons used. Can anybody, debunk that logic? Huh? There's no way you can debunk that logic. So, because rationality is based on that solid logic, sometimes, rationality may not win, but eventually it will prevail. Now, so that took took a long way around, but the point is, weighted average cost of capital to evaluate next year's capital projects must be supported by capital raised next year. Book values reflect capital raised and spent years ago. Once again, past book values are based on current market values represent our best estimate of the next year's capital market condition. Again, here, this means, if every market participant is rational, then market value will be equal to intrinsic value, right? It will be equal to intrinsic value, right? That's so it's not the short term, it's not the short run market value we're talking about here, right? It doesn't look. Intrinsic. So market values are appropriate basis for weighted average cost of capital, for capital structure, and for component cost. Calculating. So structure, assume the firm will either maintain the present capital structure based on the current market prices of its securities, or strive to achieve some target structure based on current market price, right? So step one, develop a market-based capital structure. So then it involves, valuation of our debt, right? Valuation of our debt, valuation of our equity, valuation of our preferred stock. This requires basically, what you learned in Finance 100. Stock valuation, bond valuation, right? Something you learned in, and step two, adjust market returns on underlying securities to reflect those three capital components. Step three, combine the cost of capital components in calculating weighted average cost of capital. So we'll jump into the example. The Wachusett Corporation has the following capital situation. 2,000 debt, they have debt, preferred stock, and equity, the common stock. 2,000 bonds were issued 5 years ago at coupon rate of 12%. They had 30-year terms and $1,000 face value. Of course, bonds have $1,000 face value. They are now selling to yield 10%, and then 10% is the discount rate, right? The wording either it can be worded as they are now priced to yield 10% or selling to yield 10%. That means if you use 10% as the discount rate, you will arrive exactly at the current market price. Okay?
I have a question.
Yeah.
Does the cost of debt include coupon rate?
No. Coupon rate is only the rate that this bond pays, right? Cost of debt is in a way, I see what where that's coming from. Because it's the return, annualized return. Yeah, coupon rate will be part of the cost of debt, right? But that relation is kind of indirect, not direct. It's not like coupon rate plus something is the yield. No, there's no way you can define it that way, right? Cost of debt is exactly only the yield, right? Yield to maturity, right? Of course, to calculate the yield to maturity, then because it is the return, right? It's on the annualized return, right? Part of the component is the coupon payments, right? Because there's capital gains and coupon payment over the entire life of the bond, right? And then that will give you the holding period return, and then you annualize it, and that's the yield, right? So they were issued 5 years ago, 30-year terms. That means the bonds have 25 years left, right? 25 years left to maturity. So if we do the bond valuation, applying bond valuation formula, right? We'll find the intrinsic value of the bond, right? And then intrinsic value of the bond is the market price of the bond. If the market, if the market is rational, right, under ideal conditions, right, intrinsic value is the market. So then, since there are 2,000 bonds, that bond price times 2,000, that will give you the value of the debt, right, market value of the debt.
And then preferred stock, 4,000 shares of preferred stocks are outstanding, each paying an annual dividend of 7.5. They originally sold to yield 13%, 15% of their $50 face value. Yeah, if this is, you divide this by 0.15, then you will get $50, right? If you divide, because preferred stock is a perpetuity, and perpetuity, which means zero growth. Remember zero growth model?
What's the formula for? Oh, there it is. Oh no, but that's this thing, not the. Okay, in stocks there are 4 valuation models, right? Zero growth or constant dividend. Constant growth. Constant growth, or also called Gordon growth model. 3, variable growth model. 4, free cash flow model, right? Free cash flow. Zero growth is also perpetuity model, right? Perpetuity, because zero growth means, so basically, price of the stock is dividend over, or, right? In this case, cost of preferred stock, right?
So preferred stock doesn't, the preferred stock pays dividend before dividend to the common stock. That's why it's called preferred stock. But the dividend doesn't change. Dividend is supposed to, dividend is proportional to profit, right? Dividend is proportional to profit, but that's the dividend to the common stock. The preferred stock dividend has no connection with the profit. Of course, you'll have to have some profit to pay out dividend, but what I'm saying is preferred stock's dividend doesn't change with the profit level, right? It's not proportional to profit. So the dividend is constant, always constant, so it's zero growth. And if it is zero growth, perpetuity is exactly zero growth model. So what this means, is originally, right, 7.5 over 0.15. And if you do this, try that, you'll get 50, right? You should get 50. And let me verify that. I just want to, where is my calculator? Where? Accessories, right? And the accessories. $7.5 divided by 0.15. Yeah, exactly 60, right?
But now they are selling to yield. That means, now use this as the discount rate. But then, what's it going to be? Then, 7.5 over 0.13. Then you'll find the current market price of this preferred stock, right? And then, since there are 4,000 shares, right, the result times 4,000 will give you, the market price, current market value of the preferred stock. Okay, and equity, what you said has 200,000 shares of common stock outstanding. Currently, it gave you already the market price. Not a difficult thing because market price is something you just look up in the. So then we can, with this, we can find the value of debt, market value of debt, market value of preferred stock, market value of equity, right? Then we can find the weights by finding each weight of each component. We can find weight. Okay, so that's the first thing, first step. And again, here, the assumption is that this market price is equal to this stock price, this price at time 0. This price is same as intrinsic value. I mean, normally I would use, V as intrinsic value, but then that's aggregate, so I'll just leave it as, S0. Okay. The rest of the example will take a lot of time. So it will, not a lot of time, but it will take decent amount of time. So we cannot complete it. We cannot do it today because we have only about 5 minutes, 5-10 minutes left. So let's say we call it a night here. And if you have any questions, please ask. Any questions? All righty. If you have no further questions, then I will see you guys on Tuesday. Have a great evening. And all righty. So I will stop recording.